It's time for Yahoo U. Brian Cheung is here with this week's lesson.
Well, a fresh new GDP print, which means it's time for Yahoo U. So class is in session. We are breaking down GDP. What does it mean? There's a lot of letters to break down. So let's get started with our Yahoo Finance interactive touchscreen. GDP, it's an equation that breaks down a number of different components in production in a given company. So C is consumption. So the individuals in a given economy, like the US, how much they're consuming, are they buying goods, services, etc. Next is investment. So aside from individuals, the businesses. Are businesses investing in capital for expanding their productivity or expanding their capacity? That would be captured in the I part of the GDP equation. And there's also government spending. So the government that will make a budget for military spending or for programs like Medicare and Medicaid, all of that would be covered by the G part of the GDP equation. And then the last bit is net exports. So that's exports minus imports. So if a country is exporting more than it imports, that's going to be a positive contributor to GDP. Conversely, if it imports more than it exports, that would be a minus to GDP. So let's look at actually what the record looks like in the United States. So this is a picture of the real gross domestic product in the aggregate since 1950. And you can see that it's been steadily increasing over time. But this isn't just good enough. Yes, it's good that it's positive, but we want to make sure that the economy is growing at a steady rate. That's what you would expect to see in a country that has positive future prospects is actually economic growth. So if you take a look at what we're looking at right here, you'll see that there are portions of our economic history where we've actually seen some negative changes. So we've seen some plateaus in the 1990s. That was the oil shock. We also saw in the 2000s, we had the dot-com bubble. And then we actually had a negative shock in the, obviously, 2008 era with the collapse of the mortgage market. These all show us that we would have had negative GDP growth. Now, let's take a look at the last 10 years for the economic recovery. Since 2009, you could see that, again, some of the remnants from the financial crisis have actually shown that we did have negative GDP growth for that year. But since then, it's been pretty steady. A few bumps here in late 2010. Also in mid-2014. But for the most part, recently, we've actually seen GDP kind of stabilizing. So you can see that it's been kind of on an upward trend in the 2015, 2016, 2017 era. And again, keep in mind, we are in the longest economic recovery right now as of July. So kind of remarkable that we've been able to have this positive GDP growth here. But it really contextualizes what we saw as the last data point that we got this morning, which was GDP growth of 2.1% year over year. Now, interesting because, again, you're looking at this trend over here, but you do wonder about whether or not this later part in the past, let's say 5 or 6 quarters or so, whether or not that's starting to tick down or raise concerns over about whether or not we're going to slow down again. Again, part of that being part of the global slowing picture in other countries as well. Now, GDP is important to note because it actually doesn't include all components. So one example is unpaid work. So GDP will not account for things like under-the-table pay. If you're working at a restaurant, you get paid under the table. That will not get counted in GDP. But it also accounts for things like raising a kid. That's work that actually represents a large, substantial amount of time that isn't monetized and isn't added to the GDP equation. The next is natural resources. So GDP only accounts for natural resources that are actually sold in an open market, like gasoline, for example. Anything that's untapped would not be accounted for in GDP. You also have changes in population. So in the aggregate, GDP might be increasing, but that could be just because there's more bodies to help produce things. The fourth thing is happiness. So yes, there could be more GDP, but that doesn't necessarily mean that people have better health or that people are having better living wages. And the last thing is, it kind of tied into that, it's inequality. So yes, GDP is increasing, but how do we know that all that wealth isn't concentrated at the top? Now, there are alternative measures that have been pitched in this substitute to GDP. One of them is gross national income. Gross national income actually accounts for spending in production, but it actually measures it by income and actually accounts for income that might be made by Americans abroad. That generally tends to overstate GDP, which is a reason why people don't look at it. Another one is the Human Development Index, which is used by the World Bank. This actually measures for health, schooling, life expectancy, some of those things that aren't accounted for, as I just explained. And the last is the Index of Sustainable Economic Welfare. If you recall, it actually has different accounting for natural resources that are untapped. This actually tells you that it'll account for unpaid household labor, social costs, and also environmental damage. So GDP, not a perfect measure of how an economy is doing, but still pretty interesting nonetheless that there are other proposed alternatives to this as well. So that, in a nutshell, is GDP.
All right. Thanks, Brian, as always, for breaking it down for us. Brian Cheung with our Yahoo U.